At the first video, we were talking about problem. We developed a product which will generate us profit. But now we have to discuss the issue of the value added here, because always as an economist we have to focus on the added value here. So now we can see that, okay, the company is making some profit, but does it matter? So what will be the added value here? So that's why we will calibrate a discounted cash flow model. But to do that, at first we have to calibrate the interest rates. Well, so first of all, we need interest on debt. And in this case, we can use the Icon database because we can just go to markets and fixed income markets. Then bonds, then corporate bonds, obviously because it's a company, and then this is a French company, and then we have to check for curves. So obviously companies can have A, B, C or D rated loans, and also not just companies but governments as well. So category A from AAA until to single A, they are the best and most secure categories. Category B is a bit risky but still acceptable. And category C, this is the risky territory, and D is when they are in default. So let's assume that we are in category B. So these are the interest rates for us right now. So I'll just copy and paste everything. Okay. Good. Then we need interest on savings. So obviously we are not, or we can invest it into government bonds. That's the simplest. So as a French company, obviously we will buy French government bonds. So okay. So this is based on the current data, so we can assume that we will be rated company. Also, we can calibrate Euro-US dollar rate if we have any exposure. Right now we don't have any exposure, so it's not so important. So let's keep it that way. So we will have a whole class when I can talk about this one. So yep, once we did this, then we can turn toward valuation. So in case of discounted cash flow valuation, we need the following things. So first of all, how much money can we earn from this company? And I mean money, how many, the amount of cash what we can realize. So that's why depreciation is not an expenditure here. So we are moving it back. And also taxes must be represented here because it removes some of this cash. And also floating capital, so short-term balances must be also represented here. That's one thing, because usually if we are conservative, we are looking just 5 years ahead in the future. So we can say that, okay, we know what will happen with the company from our business plan. This is our business plan here. And from the business plan, we can see that, okay, in the next 5 years, such amount of money will be generated, but obviously we have to calculate its present value to calculate it back in the current time. And in this case, we need some kind of discount rate. So that's why we will use the weighted average cost of capital, which will come from the funding sources of equity and long-term debt. And after that, also in the 5th year, still we have property from our balance sheet. What we can see here, okay, it's constantly depreciating, but still, it's if we have to sell or liquidate all the assets of the company, then property will be sold. Intangibles, so patents, know-how, trademark, and so on, softwares. For example, Ariane Space is quite famous about their metal 3D printing technology. So that's why it can be really useful. So sometimes they are just giving it to license to other companies. And also cash reserve, what is accumulated in the 5th year. All of them must be present valued backwards in today's time. Then we have to deduce the long-term liabilities, and after that we can be really happy with our cash. So first of all, we have to calibrate our long-term liabilities, because right now we are in losses and these losses are not covered. So I need debt. And in this case, we can say that the numbers are saying that I should just take up 65 million euros as a loan to cover all the losses, but come on, let's be more reasonable. So let's issue 100 government corporate bonds. So will be issued to mitigate risks and losses. First year. So if we have higher losses, still we can survive. So that's why I'm saying that, okay, let's be reasonable. And also now we can increase our cash reserve, which is nice. And let's say that maturity 5 years. So after 5 years we have to pay it back. So cash reserve will be reduced by 100. Until this point we're just paying the usual EBIT rated average bond yield, and that's all. We don't pay any additional risk premium because it's already added here. Yep. So our paid interests are higher, but come on, it's still nothing. 4 million euros per year. So if we are defaulting because of the 4 million euros, then it means that we are utterly useless in terms of revenue generation and in cost control. So that's my quite critical opinion about this. Yeah. Okay. So now let's put all the EBIT data. So let's refer EBIT here. Tuck, 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 tuck. Then taxes. So corporate income tax must be added, which lives here. Tam, 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 tam. Then, okay, corporate income tax rate 0.25 multiplying the gain interests. And financial revenues. Yep. Oh, we have financial revenues because let's ignore this because Excel will be unhappy. So I'm creating a circle. Okay, and financial or paid interests. Tap, 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 tap. Then we have to add everything together. So we can sum this thing up. Not this, and then okay. Okay, so they are nice. And let's highlight it with bold. This is also bold. Okay, spending on investments, I don't want to mingle with this one because let's assume we already did this. So we have the engine, we have the rocket body, and so on. Just finally we were able to integrate them. So it would overcomplicate estimations. This is still a class, not advising services for companies. Okay, so depreciation. We have our buildings, launch location, launch tower. We have our 3D printers and all the other equipment, and also so short-term assets minus short-term liabilities. Okay, this other category is absolutely unknown and really huge, so that's why I'm ignoring it, because it would mess up the whole estimation. So yeah, okay, so based on this data, here now we can have the free cash flow. So this number plus, sorry, minus this number, because these are taxes, plus depreciation plus floating capital will give us the free cash flow. Let's underline it and let's keep it here. Okay, weighted average cost of capital, so shareholders' equity. It's also coming from the balance sheet. And then also we should add the long-term liabilities. So debt. And also the RD, which is interest on debt. Yum, 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 yum. And now we can go back here. So we have to assign some cost for the equity. So how can we do this? We can use the usual approach from the CAPM model, what you learned already on corporate finance. So RE equal RF, so the risk-free interest rate multiplied by the beta, industrial beta, and RM minus RF. So this is what we have to replicate. Okay, you can ask the question that, okay, this long-term yield, what will it be? And it will be the interest on savings. So let's not complicate stuff. Then RM, return on the market portfolio. This is the tricky part, because if we are just checking the French, Paris exchange index, then this is the most of the historical data. So if we are just taking the difference minus this one, or obviously we can say that, okay, let's check or let's look for the increase behind them. So still the problem is you don't have data. So still the problem is that it's changing a lot. So it would be absolutely unwise to just calculate an average from this data. So it's much more reliable to say that what happened in the past, it's less important. So that's why we are creating an exponential return. So this number multiplied by lambda, and lambda on something. So this is the exponential moving average approach, which was defined and published by Goldman Sachs in the early 90s. And since then, people are using it. So as you can see it, why lambda is this number? Because they said so. So they optimized something in the background. Absolutely not transparent way. So we have no idea. I checked many different financial econometrics books, and it was just written always that they are using this. So, okay, let's assume that they are using it. This is for annual data. It would be 0.97 if it would be monthly. So let's use this lambda and just taking always the time factor. If it's in the past, then it's less important. So practically we are just removing their importance. Okay, so now we just have to take the average. So sum up all of these things and divide it by 20 years. And we can see that on average, the French stock market has this 3%. And in this case, this number is not dynamic, so it's constant. So we keep keeping it as constant. Okay, now last thing, we need a beta. Obviously, we could calculate manually by taking the covariance between the share price return and also the covariance between the Paris Stock Exchange market index, and then we should divide it with the variance of the Paris Stock Exchange index. But this is a private company, so we don't have the data. So that's why we can go for another database, which is free, because Damodaran is a really nice person, and he not just developed most of the discounted cash flow literature, but also provides us a lot of free data. So total data by industry sector. So let's go for Europe because it's a French company. We can have the Excel sheet, and then Excel sheet loads in. Then we can go for aerospace defense, and let's check average levered beta. There is not much difference, but let's look for the highest number here. So, yep, beta from industry is this one, and for the core. Okay, so now we can see that this thing plus beta multiplies RM minus RF then at the end of the day we can see that okay, this is the cost of equity. So it's right now it's cheaper to finance everything from equity, but also we can see that it's not that cheap. So practically they are the same. Like the debt is a bit more expensive, but come on, it's absolutely marginal. Okay, shareholders' equity. Let's just use, or let's create percentage from that one. So plus the debt, and in this case we can see we are using for such amount of percentage, and in this case we can just say that one minus this one. It makes our life easier. Okay, so weighted average cost of capital. So now we just have to multiply this number with this number, plus multiply this number with this number. Yay! So these are our discounts. Okay, so now we just have to say that discounted cash flow is free cash flow divided. Still the same thing what you did already on corporate finance. 1 plus this thing one, and then put it goes back. Why is this positive? Yes, because the depreciation is positive and the floating capital. Yeah, floating capital is, I think it's biases things because we have raised money from debt issuance, but okay. So the DCF is already positive because we were able to raise money, and that's why our cash reserves are filled up. So it can be a bit misleading, but okay, we can understand this. Okay, property. In the 5th year, so if we have to sell all our stuff at book value, which is quite a romantic assumption, and also intangible and cash. Okay, then salvage value will be in the present plus this divided by 1 plus this one on the power of 5, because it will happen in the future. So okay, so now we can see that value of V we have to sum up all these things plus this. They are already present value, this is already present value, so it's a good number. And then obviously we have to remove the debt, which is this number. Then we can see that the value of the enterprise will be, at least in my scenario, this will be nearly 13 billion euros. Not bad. So, okay. Obviously, since your product will be completely different than mine, so your launch vehicle will be different because you are using different engine, you are using different, maybe different hull material, you can use aluminum, but doesn't matter, or you are using different fuel type and also probabilities, then this value will be different. Okay, but right now we can see that if we can successfully implement this business strategy, then this will be the value of the company. Okay, so that was all for this video, and see you in the next one. Bye bye.